Hello, and welcome to Sovereign Analysis. If you want clear insight into the economic forces shaping the United States and the world, subscribe and let's begin. We are entering the final phase of what I call the easy energy era, a period built on cheap capital, cheap raw materials, and the illusion that global supply chains were permanent and politically neutral. For years, the Western narrative focused on carbon neutrality targets, ESG metrics, and electrification roadmaps. But while headlines discussed sustainability, something far more structural was forming in the high Andean plateaus of South America. As of early 2026, the so-called Lithium Triangle, Chile, Bolivia, and Argentina, has moved from informal cooperation to coordinated state-led strategic alignment. This is not just diplomatic signaling, it is production discipline, export control strategy, and pricing leverage. This is effectively the birth of a lithium OPEC. Together, these three countries control roughly 56% of the world's known lithium reserves. But the real power is not just in volume, it is in cost structure. These salt flats contain some of the lowest cost brine extraction resources on Earth. Hard rock lithium exists in Australia and elsewhere. Cheap brine lithium at scale is concentrated here. For the first time in the electrification era, a majority of a critical transition mineral sits under coordinated sovereign influence. This is not simply a commodities story, it is a sovereignty story, and it represents the re-engineering of industrial power. For 3 decades, the global north operated under a comfortable assumption that capital ownership guaranteed supply security. If Western firms invested in mines, secured equity stakes, and built global logistics networks, supply would remain stable. That assumption collapsed in 2026. Major private operators that once dictated terms now function as minority stakeholders inside stronger state frameworks. Chile has formalized increased state participation in future lithium contracts. Argentina has reinforced provincial control structures. Bolivia, long underdeveloped, but holding an estimated 21 million tons of untapped reserves, has pivoted from courting foreign extraction to enforcing industrial policy. The new rule is simple: no more raw export dependency. If you want lithium, you must build value locally. Bolivia's local value mandate requires foreign buyers to invest in cathode plants and battery infrastructure within its borders. No downstream investment, no long-term supply contracts. From their perspective, this is rational. For decades, Latin America exported raw materials and imported finished goods at multiples of value. Lithium offers an opportunity to reverse that economic imbalance. But for Western manufacturers, the cost implications are severe. Battery pack projections for 2026 have already been revised upward across multiple automakers. Internal industry estimates suggest potential cost increases approaching 35 to 40% under tighter brine contracts. The era of guaranteed affordable mass-market electric vehicles was built on stable mineral pricing assumptions. Those assumptions are no longer safe. While Washington focused on domestic subsidies and industrial policy incentives, Beijing executed a different strategy: long-term structural control. China did not merely purchase mining stakes. It secured infrastructure corridors, refining capacity, port access, energy projects, and long-term offtake agreements. This is vertical integration at geopolitical scale. Through expanded Belt and Road agreements, Chinese state-backed firms financed energy infrastructure in Argentina, including nuclear projects. They invested in strategic logistics hubs such as Pacific deepwater ports, designed to streamline mineral exports. In exchange, they secured preferential offtake arrangements and technology integration rights. Even when mines operate under Latin American ownership, refining often flows through Chinese-controlled networks. Approximately 70% of global lithium refining capacity sits within China or under Chinese corporate control. Raw material extracted in the Americas frequently travels to Asia for chemical processing, before re-entering Western markets as battery components. This creates what analysts call a structural dependency loop. Extraction geography does not equal supply chain sovereignty. Breaking that loop requires building refining capacity in North America and Europe. Projects that take years, face environmental scrutiny, and depend on reliable upstream supply. Time is the one variable Western manufacturers do not fully control. But beyond geopolitics lies a deeper tension: the material cost of the green transition itself. Producing 1 metric ton of lithium via brine evaporation can displace or evaporate roughly 500,000 gallons of water. This occurs in some of the driest ecosystems on Earth. The Atacama Desert receives minimal annual rainfall. Aquifers are fragile. Indigenous agricultural systems depend on shallow groundwater stability. In 2026, indigenous-led blockades intensified across key extraction zones. Communities argue that lithium expansion threatens long-term water security and biodiversity. Supply disruptions are no longer hypothetical risks. They are priced into markets. Each sustained production halt can translate into hundreds of millions of dollars in global economic impact, depending on prevailing prices and downstream contracts. Investors now factor social disruption risk directly into valuation models. The green transition promised decarbonization. It did not eliminate extractive pressure, it shifted it geographically. Consumers in major cities see lower tailpipe emissions. Communities at extraction sites see declining water tables. This social friction becomes the hidden premium embedded in electric vehicle pricing. Faced with constrained supply and rising volatility, automakers are accelerating alternative battery research. Solid-state technology has emerged as the flagship escape route. In theory, solid-state batteries promise higher energy density, potentially exceeding 500 watt-hours per kilogram, improved safety, and reduced reliance on traditional liquid electrolytes. Major global players are racing toward commercialization milestones. But prototypes are not production lines. Manufacturing yields remain inconsistent. Material stability over repeated charge cycles requires further validation. Scaling gigafactory-level output demands enormous capital investment. This creates a structural gap period. Lithium remains essential. Supply remains concentrated. Alternatives remain years from mass scalability. Several automakers have already revised or delayed aggressive electrification targets, citing margin erosion and cost volatility. This is not the end of EVs. It is a consolidation phase. Only vertically integrated players, mineral controllers, or technological leaders are positioned to maintain stability under tightening resource leverage. Meanwhile, market dynamics have shifted sharply. After flirting with oversupply in prior cycles, 2026 reflects tightening conditions. Analysts project a material deficit in lithium carbonate equivalent under moderate disruption scenarios. Prices have shown renewed volatility, moving upward toward levels that stress both EV margins and grid storage economics. In traditional commodity cycles, higher prices incentivize rapid production expansion. But this is not a typical cycle. Permitting timelines are long. Environmental resistance slows expansion. Sovereign mandates restrict uncontrolled export growth. The system is less flexible than previous decades. Any additional nationalization wave, labor strike, or geopolitical escalation could amplify price instability. This is not simply a supply squeeze. It is sovereign leverage entering the industrial bloodstream. The 2026 lithium shock reveals a fundamental principle. In an electrified world, minerals become strategic power. Control over raw resources can humble even the largest multinational corporations. The West is pivoting toward recycling expansion, sodium-ion research, and domestic refining build-out. These are rational responses, but they are medium to long-term strategies. In the short term, leverage rests with those who control extraction zones and processing networks. The green transition is not collapsing. It is entering a harder phase, defined not by marketing campaigns but by geopolitics, industrial policy, and sovereignty. The question is no longer whether electrification will happen. The question is, who will dictate its economic terms? Will the energy transition produce genuine independence? Or will it simply transfer dependency from one geopolitical axis to another? The next decade will decide the answer. Until then, sovereignty remains the ultimate currency in the age of electrification. Thanks for watching. Subscribe to Sovereign Analysis to stay ahead. And I'll see you in the next one. Take care.